Most traders do not sit down and decide to overtrade. It usually begins with something smaller. A missed move, 2 quick losses, a quiet session that suddenly feels too quiet. Then a trade appears that is almost valid, so the rules bend just a little. 1 extra entry becomes 3, and by the end of the day, the trader has worked harder, paid more costs, and learned less from the result. The dangerous question is not simply, how many trades are too many? The better question is this: when does additional activity stop adding edge and start diluting it? A strategy can trade frequently without overtrading. Some automated systems are built around many small, repeatable opportunities. A manual scalper may also have a legitimate high-frequency process. Overtrading begins when the number of decisions expands beyond the tested logic, the risk budget, or the trader's ability to execute consistently. So this video is not an argument for slow trading. It is an argument for making every trade belong to a defined process. There is a reason activity feels convincing. Clicking, adjusting, and monitoring create immediate feedback. Waiting does not. An investor bulletin from the United States Securities and Exchange Commission summarizes research showing that active trading generally results in portfolio underperformance. A well-known study by Barber and Odeon examined stock brokerage households, not Forex traders, so it does not prove that every active strategy fails. But its central lesson still matters. Trading more is not evidence of trading better. Activity needs an independent reason to exist. The first hidden cost is direct friction. Every new position may pay spread, commission, and slippage. Positions held across a rollover may also pay financing. These costs can look small when viewed 1 trade at a time. The problem is repetition. A strategy with a wide target may absorb a few extra points of cost. A fast strategy with a small target may lose most of its edge to the same amount. More trades multiply the number of times the market must first pay back the cost of entry. Consider a simple example. 20 planned trades earn an average of 0.2 R before costs. If each trade costs 0.04 R, those core trades produce positive 3.2 R after costs. Now add 40 marginal trades. Suppose those extra trades lose only 0.05 R before costs. After the same 0.04 R of friction, they lose 0.09 R each, or negative 3.6 R in total. The good setups have not changed, but the combined result falls to negative 0.4 R. The edge was diluted by activity that never met the original standard. The second cost is setup dilution. At the start of a session, the trader may wait for a clear location, a defined invalidation point, and enough room for the target. After watching the chart for 2 hours, a nearly valid setup starts to look acceptable. After a loss, acceptable becomes urgent. The chart did not improve. The threshold moved. This is why overtrading often hides inside reasonable-looking entries. Each trade can be explained afterward, even though the standard became weaker during the session. The third cost is concentrated exposure disguised as variety. A long position in Euro-US dollar, a long position in British pound US dollar, and a short position in US dollar Swiss franc can all lean toward the same broad idea, a weaker United States dollar. The relationships are not fixed, and they can change, but the positions may still lose together during the same move. Counting 3 tickets does not mean you have 3 independent risks. Before adding another trade, ask what market event would hurt every open position at once. The fourth cost is decision fatigue. Every entry creates more choices: where to place the stop, whether to move it, whether to take profit early, and whether to re-enter after the exit. A trader can begin the day with a clean plan and end it improvising. An automated strategy removes some emotional decisions, but repeated manual overrides can recreate the same problem. When the process requires constant rescue, the recorded result no longer represents either the original system or a consistent discretionary method. The fifth cost is contaminated feedback. If planned setups, revenge trades, news guesses, and experimental entries all enter the same journal without labels, the final statistics become difficult to interpret. A profitable month may hide a weak core strategy rescued by one oversized impulse trade. A losing month may make a valid setup look broken because unrelated trades were mixed into the sample. Good review requires clean categories. Otherwise, more trades can produce more data while reducing the amount of useful information. The practical fix starts with a trade budget. This does not have to be a universal number. It can be a maximum number of entries per session, a maximum number of attempts for one setup, or a maximum amount of risk allocated to one market idea. The purpose is to make expansion deliberate. If the budget is reached, another trade requires a specific reason, not simply the feeling that the day is unfinished. A limit creates a moment where the trader must notice that the process is changing. Next, grade the setup before entry, and a setup meets every required condition. A B setup may be allowed at reduced risk if that variation has its own evidence. Anything else is a no trade. The important part is timing. A grade written after the result is vulnerable to hindsight. A screenshot or one-line note before entry preserves what the trader actually saw. After enough samples, the grades can be compared honestly instead of relying on memory. A trading plan also needs explicit no-trade conditions. These might include spread above a tested limit, liquidity around a session transition, major scheduled news, abnormal volatility, missing data, or a trader who is too tired or emotionally reactive to follow the rules. The exact list depends on the strategy. The goal is not to avoid all uncertainty. It is to identify conditions where the original assumptions are absent. A good filter says why the trade is blocked and what must become true before trading can resume. After a stop loss or a missed move, use a short cool-down rule. It might be 10 minutes, one completed candle, or a full reset until the next planned session. The time itself is less important than the separation it creates. A cool-down interrupts the reflex to win back money or chase price. It also gives the trader enough distance to ask whether the next setup would still be valid if the previous trade had never happened. Before every additional trade, use a two-question gate. First, does this trade meet the written setup conditions? Second, why do I want this trade right now? The first question tests the market. The second tests the decision maker. Answers such as fear of missing out, boredom, recovering a loss, or finishing the day positive do not automatically prove the setup is bad. They do reveal that extra caution is needed. If the market reason is weak and the emotional reason is strong, the safest action is usually to wait. For an expert advisor, overtrading can be controlled with explicit guardrails. Examples include one position at a time, a maximum number of entries per day, a delay after a stop loss, a daily loss limit, a spread filter, a session filter, and rules that prevent duplicate signals from opening correlated exposure. Each limit should match the logic that was tested. Adding a random cap after seeing a bad week can simply overfit the recent result. The point is to encode the intended operating boundaries before live pressure encourages exceptions. A useful review needs more than total trades and profit. Record 7 fields: planned trades, impulse trades, setup grade, total cost in R, duplicate exposure, rule breaks, and the time of each entry. Then compare the result of the planned group with the impulse group. 1 week is not enough to declare a permanent truth, but the labels make the pattern visible. You can see whether extra activity adds independent edge or only increases friction and inconsistency. Review the data in blocks rather than rewriting the plan after every session. Start by observing what happened, then form an explanation that can be tested. Only after that should a rule change. If lower quality trades consistently lose after costs, the answer may be a stronger filter. If valid opportunities are being blocked and remain profitable across different periods, the trade budget may be too tight. The aim is not to minimize trade count. It is to preserve a process that can be measured without chasing the most recent outcome. There are times when more trades are genuinely useful. A new setup may diversify the strategy. A second session may add opportunities that behave differently. An automated system may execute a small edge often enough for the statistics to become meaningful. But the added trades should be tested separately, include realistic costs, fit the account's risk capacity, and remain executable under actual broker conditions. Frequency is a feature only when the additional trades bring additional evidence, not just additional excitement. Before one more trade, ask 5 questions. Does it meet the written setup? Is it independent from current exposure? Are spread and execution conditions acceptable? Is the risk still inside today's budget? And would I take it if the previous trade had not happened? If the answers are clear, the trade may belong in the process. If they are vague, doing nothing is not a missed task. It is a decision to protect the quality of the data and the capital behind it. If this video helped, subscribe to Atsushi K. Forex Lab for more practical videos about Forex research, MetaTrader 5 tools, backtesting, and expert advisor development. Forex and CFD trading involves substantial risk. This video is for education only and is not financial or investment advice. Historical, backtest, and example results do not guarantee future performance.